Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by MarketFi. I'm your co-host, Joel L. Connon, along with Brent Slava, and we have Aron Pinson on the line. He's the CFA, co-founder, and the Chief Investment Officer at LPS Financial LLC. Aron, how you doing this morning?
I'm doing well, Joel. How are you?
Good, good. I just want to start here. We've talked Greek, we've talked some insurance takeovers, but last time we were on the show, we were talking a little bit about, Netflix. And I got a bad printing here on the weekly chart. And, you weren't bullish, you weren't bearish, but you said there's going to be an extreme move one way or another. Well, you had the extreme move up. Mr. Icon comes in. I mean, is it possible that, he pretty much put the bottom in the stock? You think he's going to put the top in it as well?
It's anything's possible with Netflix. I mean, one thing, again, we went over some of the numbers last time with it. One thing is certain with Netflix is that there's going to be extreme volatility. That was my thesis back then. It's still 100% intact. This thing, if it works out, could be one of the most valuable companies out there in the media space. Their costs are fixed. They have so much leverage, both financially and from an operating level, that to see the stock trading much, much higher or much, much lower is, either way is extremely possible. So the one thing that you want to always bet on Netflix is going to be wide moves and major moves. Obviously, the obvious question and the million-dollar question is what direction, and that's something where it's just above my pay grade, way too hard to predict. But definitely, if you look at Carl Icahn and the type of returns that he generated in the name, especially in the time frame, you're talking about astronomical returns, both on a monetary basis, on an absolute level, and then even a relative return. You're talking about over 1,000%. So.
What about the content cost? And that kind of, they're really extended on some of their content contracts going out in the future. I mean, is that something you think is a little ignored on the balance sheet? That everyone's just looking for worldwide expansion to offset the content costs.
Right. So that's really the key. I mean, I think it's item number 8 on their SEC filings. When you look at their 10Qs and 10Ks, they always highlight how much a content cost the company has that is not even brought onto the balance sheet. So if you look at just your average company assets minus liabilities, that's your equity value. In the case of Netflix, it's stated assets, stated liabilities, but then you have off-balance sheet assets and off-balance sheet liabilities, where if you look at those liabilities and the amount of content that they are liable for, and the only reason they don't have it on the balance sheet, it's not as if it's not real. They don't have it on their balance sheet because it's not exactly determined exactly how much they're going to be paying for it, depending on how many times each individual movie gets streamed. There could be different contracts that they can't put a specific number on it. But if you look at the estimations in the filings, you're talking about billions and billions of dollars, where again that just adds to the on top of the operating leverage and on top of even the regular typical financial leverage. So that's something where, as an investor, you have to be concerned with that. But again, just like any type of leverage, it maximizes, Joel, both the downside but also the upside, and that's why you could see moves from 50 to 500-600. And again, in a couple of years ago, it was the worst performer in the S&P 500. So far this year, I think it's, if not number one, definitely in the top few best performers so far year to date as well. So you'll have those extremes going both ways.
All right, moving on here, and just like the thing to do is to split up your company or spin off something, get shareholder value, REIT status is another thing. Well, what do you think about eBay with the PayPal spinoff?
Right. So eBay and PayPal is probably one of the most anticipated spinoffs in a while. Carl Icahn's also involved in this name. I think the thing that I'm looking at, Joel, is that PayPal is probably going to be one of the most talked about stocks out there. It's going to be a hot stock. Lists on momentum investors. You'll see traders, day traders, getting involved with PayPal. So if you look at typical CNBC, Bloomberg, it's probably going to be talked about a lot more than the other half, than eBay, and probably again be quite expensive when it spins off. If you look at it from a valuation perspective, because it is the leader in the industry is growing, and it's something where everybody can relate to it. So many people know the brand, know the name, and it's something where for the last 10 years, people are talking about trading and getting involved in eBay for that PayPal trade. Now that it's going to be a standalone, I think it will be in very high demand. The post I wrote this morning, actually, Joel, really highlights that PayPal, because of that fact that it probably will come out and be pretty expensive as far as from a valuation perspective, it's probably not going to be the best way to play this. There's going to be a lot of risks with PayPal. If you look at Apple Pay, Google Pay, if you look at Amazon does payments, you're talking about extreme competition. And the key factor is that this is a space, an area which is changing drastically, not only on over the longer term, but even on a month-to-month basis. There's so many different changes and technological advancements that are going on in this space that it's pretty hard to bet one way or another with much certainty. And although it might seem like the safest bet is to bet on the leader and the current leader in any industry, that's the one that also entails the most risk, as PayPal has the most to lose, with their market share right now. So I have the opinion that eBay is probably not only a safer way to play it afterwards, where after the split off, eBay is just going to be the marketplace business. But I think that's an extremely attractive business with higher profit margins. eBay doesn't go and actually sell the actual products. They don't ship it themselves. They don't maintain warehouses and supplies. They're just a middleman that take, on average, high single digits, 8-9% of each transaction on average, and extremely high margin business. And that's probably going to be sort of overlooked by a lot of investors on Wall Street, where, again, I think most of the investors are going to gravitate to the more, sexy-looking PayPal and sort of leave eBay behind, and that might create a tremendous opportunity for eBay. And actually something we spoke about, Joel, I think it was either last time or maybe a couple months ago, and I was on with Qualcomm, where there are two business segments. Each one has a different a reason, a different capital structure. If you look at their business segments and why each one, in regards to Qualcomm, might look differently in case something does happen with a split off with Qualcomm. With eBay, it's the same exact thing, where because eBay's marketplace business is so consistent and high margin business and very predictable and not too much as far as changes in what they're doing, I think that easy path for return with eBay would be some financial engineering. They could load up on some debt, recapitalize their balance sheet, buy back lots of stock, and to me that's an easy way to get returns. You don't have to rely on who's gaining market share and new product inventions. Financial engineering might not be the favorite for a way to see returns by a lot of investors, but it's definitely very effective.
Aaron, eBay has competition too, though. We're getting a chat here that some people are, selling on Amazon now and leaving eBay here. So, I mean, you mentioned competition for PayPal with Apple Pay and stuff, but, eBay's facing some stiff competition as well.
It has. I think most of that is definitely the headwind behind that has already passed. If you look at both eBay and Amazon, they sort of settled in their market share space already. If you look, 4 or 5 years ago, where Amazon at that point was predominantly selling their own wares, and they've shifted to getting more sellers on their platform, and now they've taken away a lot of that eBay business. But that, I think, is already sort of settled in, where they're the sellers either sell on both platforms or already moved over to Amazon. I don't think the risk going forward of change is that great in any of them, where sellers know they're either going to eBay or Amazon, and they've already sort of settled down where they're going to be. And if you look at the numbers, eBay's gross merchandise enterprise volume as far as what they sell on their platform continues to grow and has grown even through this shift and this Amazon competition, which, don't get me wrong, is very real. It has taken away a percentage of market share, but since the whole entire marketplace is growing so quickly, eBay has maintained not only their top-line revenues, but have grown that very, very considerably as well.
Staying on the subject of financial engineering, we have a company here, IAC Interactive Corp. Big news. They're spinning off Match.com. You have some Axiom maintains a buy on it, raises price target to 100. Street's getting bullish on this breakup. What's your take on this?
Right. So IAC Interactive is extremely interesting, and to give it a little bit of background, Barry Diller, the founder of the company, has a history of sort of incubating a lot of these smaller companies and taking equity stakes in some of these companies, and then once they grow to a specific size large enough, he lets them sort of on their own and spins them off. So if you look historically with IAC Interactive, you're talking about names like Expedia. You're talking about names like LendingTree, Home Shopping Network, Live Nation. Lots of companies have come through IAC Interactive over the years, and once spun off, have done extremely well on their own. And right now, Match.com, if you look at their group of businesses, it's not only Match.com. You're talking about Tinder, of course. That's what everybody's speaking about. You're talking about OkCupid and many other dating sites inside the Match umbrella. You're talking about a business that we think can generate close to $400 million in EBITDA this coming year, and just based on the growth, and of course they're a major leader. They're by far and away, if you look at the group of companies, the leader in this dating business. We think that it's on its own could be valued at about $4 billion or so. So that's going to be a huge business. We like it a lot. Obviously, it's going to be a much more growth part of the business. If you look at IAC's other business, the Ask.com, the Dictionary.com, About.com, those are much slower growing and in many cases not even growing at all businesses, but they're generating tremendous amounts of cash flow. But those are, of course, going to be valued at a much lower multiple than the fast-growing Match business. But I think the way you have to look at IAC Interactive, and it's really been this way always, is you have to look at it, at sum of all parts. You want to look at each part of their segments, each part of their businesses, and put a little value on each one. Try to group them all together and see what the total is worth. And if you do that calculation, and I did write a post earlier in the week, and I actually shared a simple spreadsheet online that you can go check out as well, where each part of their businesses, whether it is the Tinder, what that's worth, a Home Advisor, if you look at Vimeo, a lot of different businesses that are inside that umbrella of IAC Interactive. Now that they're doing a spin, you're starting to see some of these things get unlocked, and that's where that catalyst is, and that's why you see, like you mentioned, some of these upgrades on Wall Street over the last several days since they announced the spin-off last week.
Yeah, and Axiom analysts made some comments today, and they see the IAC stock price worth $100. He just bumped his target from 85 to 100. Do you agree with that valuation, or do you have a price target on it?
Right. So price targets are always pretty hard to put out, especially when you're looking forward. But as far as a valuation, in my sum of parts, I did put a valuation of $92.71. That's just the math that came out based on each of the values of each of their businesses, and that does not include, by the way, Joel. I know you guys, based in Detroit, but if you come here and ever drive up the West Side Highway in New York, you have the IAC headquarters stands out on the West Side Highway, which is probably worth a good $1 billion on its own as well. And that's not even including the real estate. Just the operating businesses, I think, are worth close to 100, but about $92, $93 a share based on my analysis.
Oh, okay. All right. Just any other comments? How about, I know this is getting way out of your wheelhouse, just with everything that's going on with the Greek crisis and the resolve and everything here. I know you like to stick to your analysis and your numbers, but could you just give us any just overall thoughts on the market?
Right. So on my main macro thesis is that I hate macro. I wish I could just always focus and not have to worry about what's going on externally with things that are probably not going to affect any of the businesses I'm investing in. I mean, there's no reason why 90% of the companies that I own or that I follow or that I write about or talk about 90% or maybe even more are going to be affected from what's going on in Greece. Their businesses are not changing. Their revenues are not going to decline or increase based on any outcome and what's going on with Greece. So it is unfair as a shareholder to have to worry about it and also to see the stock fluctuating in the short term based on headlines that are coming from it. But obviously that's the markets we live in, and it's something where, again, I try to tell our clients and for my own personal sanity as well, that you always want to focus on the longer term. The short-term swings of the markets are just more temporary, and over the longer term, if the companies and the businesses do what we're expecting them to do, and whether they're events like a spin-off or just the earnings and the revenues of the businesses growing, then the stock price will take care of itself over the longer run. And all these worries about Greece and these headlines that are just causing some fluctuations here and there, these things will fall by the wayside when all is said and done.
Sticking to what you know, it's Aron Pinson, CFA, co-founder and chief investment officer at LPS Financial LLC, joining us here on Benzinga's Pre-Market Prep. Aron, great fundamental information. That's what we need from you on this show, and that's what you provide us. Thank you very much.
Thank you so much.
We'll talk to you again soon.
No worries. Thank you so much, Joel. Have a great day.